changes happening, and what does this mean for you? We are now joined by Sandeep Junjunwala, who's a partner at Nangia Global Advisors, joining us now. Sandeep, thank you so much, first of all, for taking out the time. My first question, before I take these changes individually, according to you, what are the major changes that one must keep in mind before entering this FY27 in order to kind of keep in mind their taxes into consideration?
So, Mahima, it's important for the viewers to know that the Income Tax Act doesn't go off the shelf immediately and completely. So, in some sense, it is not a control, alt, delete kind of moment. Don't know, we were experts until yesterday, and then we are becoming an index hunter today, because the entire act has been rewritten in a way that the section numbers, the rule numbers, those references have undergone a complete change. But I think we need to understand it by bucketing all the transactions into three categories. One is, say, for instance, the filings for FY25-26. For instance, the TDS returns that needs to be filed for Q4 of 25-26, that will follow the Income Tax Act 1961. Any TDS return that is going to be filed for Q4 is going to follow the formats of 1961 Act itself. And this also applies to the return of income. So anyone who's going to file the return of income, be it a corporate or a non-corporate, as it pertains to financial year 25-26, I think those all need to follow the formats largely of the 1961 Act. In fact, we had all the ITRs notified yesterday. Now, the second bucket is the transactions that pertains specifically to the financial year 26-27, which starts from today. Now, in that category, I think there are major changes. Say, for instance, in the case of a salaried employee, there are changes from HRA perspective, for instance, where the new metro cities of Ahmedabad, Pune, Bangalore, and Hyderabad have been included. There have been some rejig in allowances, say, for instance, the education allowance, hostel allowance, and perquisites also. So that probably will require a little bit of evaluation for the salaried folks to understand whether they need to maybe go back to the old regime, because until now, new regime was by default, chosen. So if old regime, where all these allowances and perquisites are still given at a, much better rates, if that makes sense, then possibly it's a time for them to reevaluate and switch back to the old regime. Now, continuing the, category of transactions in FY 26-27, some of these forms requires Form 15 CA-CB, which is pertaining to foreign remittances. The thresholds for PAN and SFT, those have undergone changes. A classic example could be a person going and deposit money in a bank where, say, for instance, the cash deposit is more than 50,000 rupees. Yeah. It earlier required, them to code their PAN. Now that limit has been increased to 10 lakh a year. So technically, those are the changes, that comes into picture. And then we have the third category where we'll have to do the filings for financial year 26-27, which will come next year, in the next calendar year itself. I think largely we will see all the changes there, where because the forms related to tax audits, some of these details of accounting software, the IP servers, etc. I think those will be the significant changes that will probably kick in maybe next year when we see the filings for 26-27 coming in.
Okay. Sandeep, with regards to your ITR filing as well, there has been a slight change in timelines as well. Can you give us a perspective on that?
Yeah, so that definitely allows the taxpayers to file the revised return with an extended window of 12 months, which was earlier 9 months. And of course, there has also been a change in the timeline for filing of returns for tax audit versus non-tax audit cases, which will apply to all the returns that pertains to FY 25-26, and therefore taxpayers can take the advantage of that extended window for the filings that they have to do in the current year.
Sandeep, they've also introduced something called tax year concept, because financial year, assessment year, etc. has been confusing for a layman, right? Give us a perspective on what has changed here.
Right. So we always used to follow the concept of financial year and assessment year, Mahima. So where, financial year is a year in which actually you undertake a transaction, and assessment year is the year which is 1 year ahead or preceding the financial year, where the income was assessed and, first reported and then assessed. Now they have tried and unified that concept by saying that, going forward, we will, continue to call it as a tax year. So no more concept of financial year and assessment year, because there used to be confusion, at least for the common man, to understand what is the financial year and what is the assessment year. Now, going forward, everything is unified in terms of saying that it will be a tax year. So it will be called as tax year 26-27 going forward.
Okay, Sandeep, the other aspect, and this was there, this was also a part of the budget, buybacks being taxed as capital gains rather than deemed dividends, Give us a perspective from an investor point of view. How does this change taxation for them?
Okay, so I think when it comes to buyback, Mahima, I think this has just gone a full cycle. I think this is more of a classic example for a policy in motion.
Correct.
Now, what the budget, earlier this year tried to do was to try and plug the tax arbitrage which was available for the promoter group between a capital gains and a dividend. Now, I think largely it impacts the promoters, and promoters are defined to mean people who have more than 10%. Shareholding in a particular company. So what they have now done is they have introduced a concept of top-up tax. So which means that the tax rate which will be applicable for buyback and dividend would largely remain the same for the promoter group because of this introduction of top-up tax. And they've also now, recently, I think 2 days back, clarified that there is a flat 12% surcharge that's going to apply on the capital gains, which is in some sense good as well as bad. Good for people where the capital gains arising on buyback is more than 1 crore, where a higher surcharge of 15% was applicable. So technically they stand to gain by 3% reduction in the surcharge rate. Whereas if the capital gains was a smaller number, say for instance of 50 lakh or anything less than 1 crore, then where no surcharge was applicable, now there will be a flat 12% surcharge applicable. Having said all this, I think it's very clear that this will all apply to the promoter group. So for the non-promoter group, whatever surcharge is applicable to them as per their particular slab category will continue to apply.
The other interesting update, Sandeep, is with regards to your credit cards. I think, if I'm not wrong, the new act suggests that if your credit card bill goes over that 10 lakh rupees, the bank is now supposed to give that statement to ITR. Just want to understand that what are the implications of this rule coming in?
So I think they have done a lot of, threshold rejig when it comes to SFT reporting. So SFT reporting is something which is to be done by, financial institutions, banks and companies where, they deal with a larger set of consumers and, stakeholders. So for instance, in the example that you gave where the credit card payment, specifically if it is done by way of cash, for example, and it exceeds 10 lakh rupees in a year, then the bank is going to report that to the income tax department. And obviously that gives them a more curated data to look at, to understand what is the income pattern, what kind of disclosures of income has been made by that particular taxpayer in the past, whether it is proportionate to the income that is being offered to tax, etc. And I think that's what is largely going to happen by way of all the rejigs that has happened in the threshold as far as it concerns the SFT.
Got it. With regards to sovereign gold bonds, Sandeep, I think the tax exemption on maturity now applies only to the original subscriber, not the person who has bought it in secondary market. What are the implications of this?
See, I think any which case, there are no new issuances of the gold bonds that are happening now, right? But yeah, as you rightly said, for the earlier tranches where people have already bought it, they have curtailed the benefit. It will not apply to people who have bought it from the secondary markets. And therefore, in some sense, it's also discouraging to people who have held it in the past. But as I said, I think that's not an instrument that's live today. So maybe if people are planning to, invest in this category, they may have to probably wait for the next set of notification whenever the government comes up with.
Got it. Sandeep, what are the major TDS and TCS changes that one need to keep in mind?
See, TDS, I think, Mahima, the rates don't change, but obviously the section references change. So I think a lot of companies are relabeling and recoding the new sections and rules into their ERP systems, which is as good as, rebuilding the map while the traffic is still moving. Because I said that, for a certain part of the year, current year also, they need to probably give references to the old sections itself. Whereas after that, they need to probably give reference to the new TDS section, which is the relevant table in section 393. But as far as the rates are concerned, rates don't undergo a change. Yes, TCS rates have been aligned. I think largely it falls in the category of 2 to 20%. Say, for instance, there were multiple rates when it came to the TCS on LRS, for example. Now they've unified it and made it a uniform rate of 2%. So some reaching in the rates of TCS, but largely the TDS rates remain the same.